Hello everyone, thanks for joining me for this edition of Making Sense. The markets have been pretty volatile lately. I received many calls from clients, especially early in April when the tariffs first took effect. And we really tell our clients three things. First, we ask them to log into Investor 360 and take a look at the performance of their portfolio, rather than listening to what goes on in the media. And most times the response is that it really doesn't look that bad. The reason that is we use diversified portfolios to include bonds and alternatives, and that helps minimize the drop in these difficult times when the stock market is under a lot of pressure. Secondly, we tell them to don't panic. Now is the worst time to make adjustments to your plan and your portfolio. Let the volatility settle down, and then we can meet and talk about making adjustments then. And lastly, what we do is rebalance their portfolios. So what we do is sell things that have held up well, like the bonds and alternatives, sell some shares, and use the proceeds to buy shares in the equity funds that have dropped more than the bonds and the alternatives. So in effect, we're taking advantage of the drop in the market to sell shares of investments that have held up well and buy shares of the equity funds that are lower. So we're selling high and buying low. If you have money flowing into your retirement plan at work, or you have cash on the sidelines, it's a great time to do more if you can and take advantage of this drop, because 2, 3, 5 years out, most likely the market will be higher than it is today. Thank you, and please call anytime with questions.